Hello, everyone, and thank you for joining us today for our Introduction to Depreciation webinar with Mark Dykman from Kansas State University. My name is Sarah Campbell. I'm here with USDA as part of our beginning farmer and rancher team. Just a little bit of housekeeping before I hand it over to Mark, who's got a lot of great content for everyone on this incredibly timely and important topic as folks are heading into tax season. This webinar is being recorded. The slides and the recording will be made available and posted online. It usually takes us a couple of weeks to caption and transcribe these webinars before we post them online. They will be available. All of our webinars are available on farmers.gov/taxes, as well as our tax YouTube channel on the farmers.gov YouTube page. So if you have not visited farmers.gov/taxes, please make sure that you do. There's a lot of really great resources there. We have partnered with tax experts around the country to deliver timely information about important tax topics that producers need to know about. It's been a very wonderful long-term project, and there's a lot of great information there. And we do a new webinar every month on some kind of relevant or new tax topic. So just a reminder, this is being recorded. Those materials will be available online. There's just a little bit of a lag with the posting due to our captioning processes. Also, if you have questions during the presentation, please put them in the Q&A box. We may not be able to get through all of them today, but we plan to follow up with folks afterwards if there are still unanswered questions. So without further ado, I'm going to hand it over to Mark.
All right. Thank you very much, Sarah. And Janet, appreciate both of you coordinating this. I'm happy to be here this morning and I'm excited to talk about depreciation. We'll start with just a little bit of a plug for Janet mentioned the farmers.gov/taxes. A lot of that, the work for materials there, or a chunk of that work is also or has been contributed by a group that kind of specializes in farm income tax and education related to farm income tax, ruraltax.org. Quite a bit more information there, and some a variety of tax related income tax related topics there. So we'll start with a little bit of a disclaimer. Want to make sure that everybody knows that what I'm going to present to you should not be considered legal advice or tax advice. It's merely to educate you, and because this subject is so broad and in some ways nuanced, I may be speaking in some generalizations today. I may be speaking at a high level and not getting into the nitty-gritty, the details that can be very important in this with this topic. So make sure that you are consulting with a tax professional and let them know about your individual situation. Get very specific advice for you and you alone. Let's maybe start with kind of high level. What is depreciation? In the farm area, producers or farmers or ranchers are going to buy a variety of inputs. A lot of different things are needed to make the business function. A lot of those purchases, a lot of those things that they purchase are consumed within 12 months of purchase, and we treat those as a deductible expense when they're purchased. Things like seed, like chemical, like fertilizer, like feed, those sorts of purchases don't last more than 12 months, typically. So we deduct those as a current expense. However, when we get to capital items, larger or longer life property, things that are not going to be consumed within 12 months, then we're generally going to use or generally going to recover that cost, the purchase price of that, over a number of years. And that recovery process that occurs through an income tax deduction referred to as depreciation. We're accounting for the cost of that piece of property over a number of years. So what types of property can be depreciated? Well, in a farming context or an ag context, generally going to be property that you own. There are some situations where in a non-farm business, a storefront, where we may be able to depreciate to improvements and things like that to a building that's not owned. We're not going to deal with that in the ag context. That property also needs to be something that's used in the business or an income producing activity. It needs to have a determinable useful life, and some of that is kind of predefined for us in ways. And that life should be, that determinable useful life should be expected to be longer than 1 year. If it meets those requirements, then we're generally going to depreciate it. Things that don't have a determinable useful life, like land, for example, it is a capital item, but it is not depreciable. That useful life is extremely important in determining or in calculating depreciation. So what do we need to know in order to calculate depreciation or determine how much depreciation a piece of property, how much I'm going to take on a piece of property? There's a number of things that I need to know. We're going to look at each of these in turn at a somewhat high level, but I'll give you some information about each of these different categories. We need to know the date the item was placed in service. We need to know the basis of that item, what depreciation convention we're going to use, what recovery period, the depreciation method, how much 179 expense deduction am I going to take on that item, and am I going to utilize special depreciation allowance or bonus depreciation? All of these kind of come into play. All of this information is needed to determine depreciation calculations for a particular piece of property. We'll start with the date placed in service. And this is the technical definition is a piece of property is placed in service when it is ready and available for a specific use. I want to point out and be very clear that the property does not have to be used for that particular use. It just has to be ready and available. So as an example, our ag producer, Amaya, has purchased a planter. She purchased that on December 12th of 24. But the planter wasn't delivered to her until a couple days later on the 14th of December. However, the planter sits there and she does not actually use it to plant anything until April 1st of the following year. So what date is it placed in service? When it is ready and available. And it was ready and available when it was delivered to her, even though she did not use it until several months later. So December 14th is the date that item was placed in service. The next big question is, what is the basis of the property? So in general, basis is going to be the cost of the property, so what you paid for it, but it's also going to include expenses for delivery or assembly or installation, plus any sales tax that might have been paid at purchase. I also want to point out that items that are financed, so I may not have a cash outlay. My checking account may not be impacted by that purchase. Maybe I finance the entire purchase. The amount that I finance is still considered part of the cost of the property. So I don't have to have a cash outlay to to be considered the cost of that property. Since 2018, we've been dealing with kind of a new set of rules when it comes to the basis of property when there's a trade involved. That trade-in can kind of can make the determining basis a little bit complicated since those rule changes beginning in 2018. So for property purchased after 2017 that where a trade is involved, the basis of the new property is going to be the total of the portion that I pay in cash or finance, either way, plus the amount that the dealership allowed on the property that was given up. So as an example here, producer Jace purchased a tractor. He paid $50,000 in cash, wrote a check for that, and traded in an older tractor, gave up the older tractor that the dealer valued at $75,000. In this case, his basis of that in the new tractor is going to be $125,000. And that's the total of the $50,000 of the trade allowance or the trade difference, plus the $75,000 that the dealer allowed him. Now, it's important to point out that to get to this point, Jace would also have to treat the old tractor as if it were sold and recognize the gain on that $75,000 transaction. So we're kind of even though that $75,000 didn't change hands, we treat it as part of the basis of that property because of the tax rules that we're working under. Next item we need to know is the depreciation convention. And the convention is going to determine, it's most important in the first year or the year the property is placed in service. It's going to determine the portion of the first year or portion of the year that we get to claim depreciation on that property. So generally, when we deal with farm property, machinery, equipment, buildings, ag buildings, livestock, whether it's breeding livestock or dairy, in general, the half year or mid-quarter convention are going to apply. When we get into residential rental property and non-residential real property, so commercial buildings, then the mid-month convention is going to apply. We'll look at the half year and mid-quarter in a little more detail here next. For the most part, we can kind of assume that the half-year convention is going to apply when dealing with farm property. We're going to assume that the half-year convention is going to apply, except in one particular circumstance, and that is when more than 40% of the total basis or bases of all assets, all the property that we bought, if more than 40% of that occurred in the last quarter of the year, then the mid-quarter convention applies. And the logic behind that is that prevents me from going out and buying all of my equipment on December 30th or December 31st and claiming a half-year depreciation on those on that items. So if more than 40% occurs in the fourth quarter, then we're going to switch to the mid-quarter convention. Now, I mentioned the applicable property. That applicable property does not include non-residential real property. So those commercial buildings, we're excluding that from this calculation. Residential rental property, rental houses, apartments, those are not going to be included in this calculation. We're also going to exclude property that we bought and sold or placed in service and disposed of in the same year. That's excluded. And then finally, we're going to exclude amounts that we deduct using 179 expense deduction. And that can be helpful to us. Um, if I find that the mid-quarter convention applies and maybe I wasn't expecting that, it may be possible to take some 179 deduction on one of those items that was purchased in the fourth quarter, maybe shifting below that 40% limit and changing then from mid-quarter to half year. There is some planning considerations to take into account when we're dealing with half year and mid-quarter. So like it sounds, like it the name implies, the half year convention means that I'm getting basically 6 months of depreciation in that year that the item is placed in service. Mid-quarter gets a little more complicated. If mid-quarter convention applies, then I start depreciation on property at the midpoint of the quarter where it was placed in service. So if something was purchased or placed in service in the first 3 months of my year, the first quarter, then, and again, the mid-quarter convention applies, then I'm going to take 7/8 of a year of depreciation on that item. That equates to 10.5 months. If I bought it or if I placed it in service in the second quarter, then 5/8 of the year, 7.5 months. The third quarter, 3/8 of the year, or 4.5 months worth of depreciation. And then finally in the fourth quarter, if it was placed in service in the fourth quarter, I only get 1/8 of the year of depreciation on that item. So you can, from these, you can kind of see why we might want to move away from mid-quarter if possible, especially if my equipment or breeding livestock, whatever it was, if that was heavy in the last quarter of the year. Let's look at an example really quick. Pierce purchased a grain cart on July 10th, and he paid $65,000 for that grain cart. Also purchased a corn header, a corn head on October 20th for $60,000. The grain cart would be purchased in the third quarter. The corn head purchased in the fourth quarter. So we want to calculate what percentage of the total basis applies to the fourth quarter. In this case, that does work out to be more than 40%. So we will switch from half year convention to mid-quarter. And you can see the calculation there, $60,000. $60,000 paid for the corn head in that last quarter. Total purchases for the year, 65,000 plus 60,000 or 125,000. 60,000 divided by 125 gets me to 48% or more than that 40% threshold. So again, that mid-quarter convention is going to apply. For that grain cart, because mid-quarter applies, because it was bought in the third quarter, we're going to take 3/8 of a year of depreciation on that. The corn head, because it was in the fourth quarter, placed in service in the fourth quarter, we'll get 1/8 of a year on that item. The next piece of information we need to know to calculate depreciation is our recovery period. And that can be summed up as saying that's the number of years that the property is depreciated. However, there's two options when it comes to recovery period: the general depreciation system, or GDS, which applies most of the time, and ADS, or alternative depreciation system. It is possible that if needed, a taxpayer can elect to use ADS, which in most cases will increase the recovery period or increase the depreciable life, and have the impact of slowing down or decreasing depreciation in the first year, in the year that that property is placed in service. If for whatever reason maybe income is too low, and I want to maximize a credit or some other deduction, then it might make sense for me to slow down depreciation and show a little more income than I would using GDS. One of the best resources when it comes to understanding recovery periods or depreciable lives is Pub 225, the Farmer's Tax Guide, Table 7.1, which I've got a snippet of it included here. That identifies, for the most part, all of the life, the recovery period that we're going to for nearly every piece of farm property that we're going to worry about with depreciation. One item I'd like to point out is that there is a distinction between new equipment, which has a recovery period of 5 years, and used machinery and equipment that has a recovery period of 7 years. That can come into play and can be very important. I'm only showing you about half of the list of recovery periods here, but again, refer to Pub 225 to say Table 7.1 for more information on those recovery periods. You can see from the table that there's a column for GDS and a column for ADS. So again, if I elect to use ADS instead of GDS, that does change the recovery period for many classes of items. I mentioned used machinery earlier. Under GDS, that is 7 years. But if I were to make the election to go with ADS, with alternative depreciation system, then that changes to 10 years. I think it's important to point out and understand that even though the recovery period is a specific number of years, 7 years for that used equipment, it's important to understand that depreciation actually occurs over one additional year relative to the recovery period. And that's because that first year, I'm only taking a portion of the total year. So to catch up at the end, I'll have the final year of depreciation for a piece of property will also be a partial year. So as an example, Courtney has purchased a used hay baler. Because it's used, we're going to use a 7-year life under GDS. If we assume that the half-year convention applies, that first year where the baler is placed in service, we get a half year that year. Years 2 through 7, we're going to take a full year of depreciation, and then a final. We're going to clean things up, take the remaining amount in year 8. So a 7-year piece of property, but we've depreciated it over 8 tax years. The next big question in this process is depreciation method. The method, like it sounds, determines how quickly or the timing of the depreciation deductions. So for most farm property that has a life of 10 years or less, The default depreciation method is going to be 200% declining balance. I'm not going to get into the details of how that's calculated, but 200% declining balance is it works out to be of the methods we'll mention here, it will be the most depreciation in the year the item is placed in service. We do have elections available. If I want to slow depreciation, I can use 150% declining balance. I can elect to use GDS straight line or ADS straight line. Again, each step along of these elections would slow down depreciation in the year that it's placed in service just a little bit more. For farm property that has a recovery period of 15 or 20 years, so longer life ag items, the default depreciation method in that case is 150% declining balance. So we can't take that 200, but I can still elect to use either GDS straight line or ADS straight line, depending on the situation. I'll point out that by making an election to switch from, let's say, from 200% declining balance to 150% declining balance, if I make that election, I make that on a class by class basis, and it applies to all items within that class. So if I choose to switch from 200 declining balance to 150 declining balance for 7-year property, then all 7-year property, that election applies to all 7-year property. It doesn't impact property that is 5 years or 10 years. I need to make a separate election for each of those classes. If you'd like to know some of the differences in the calculation of different depreciation methods, I'll point you to IRS Pub 946, How to Depreciate Property, and excuse me, and mention that Appendix A has several tables of depreciation on the calculations for each year of life. If you're interested in determining or understanding more about how much happens when, that would definitely be a place to look. Next big decision when it comes to depreciation is the 179 expense deduction. So this section 179 deduction is an election, and I can choose to expense part or all of qualifying property in the year that it's placed in service. This gives me a lot of flexibility when it comes to tax planning, because that election is a wide range from basically from 0 to 100% in most cases. And I can make that election on a property by property basis. So I get considerable flexibility there. The 179 expense deduction applies to most ag properties that we deal with some exceptions. Machinery and equipment, livestock, that is draft, breeding, or dairy, grain storage facilities, single-purpose ag structures and single-purpose horticultural structures, 179 is going to apply to, and irrigation equipment or drainage tile. All of those are eligible property when it comes to the 179 expense deduction. One notable thing that is not in this list is a farm shop or a general purpose farm building. We cannot use 179 expense deduction on general purpose ag buildings. There are several limits that apply to the Section 179 expense deduction. The first is a dollar deduction. So for 2024, the most I can take in Section 179 is 1,220,000. That's indexed for inflation, and it bumps up a little bit each year. So in 25, it will be slightly more. The second limit that we need to worry about with Section 179 expense deduction is the deduction itself is limited to business income. So wages that I earn as an employee, my farm or ag income, I might have a non-farm business that files a Schedule C. That income is considered business income. If I'm a shareholder or a partner in a pass-through entity, then certain income coming from that entity can be considered business income. And then finally, gain from the sale of business property, which is typically these items are reported on Form 4797. That gain can be considered business income, and the total of all those items is the maximum that I can take in Section 179 expense deduction. The last limit to worry about with 179 is the investment limit. This doesn't apply as often as the other two limits. If if I make investments of equipment more than for 2024, more than 3,050,000, for each dollar of investment above that limit, my the $1.22 million limit, that dollar limit is decreased by $1. So eventually, if my investment is too great, 179 is not available at all for me. The deduction itself is much more beneficial to small businesses than larger corporations, but those limits can be important, especially considering the cost of ag equipment recently. Those dollars can add up very, very quickly. The last item to worry about is special depreciation allowance. This is commonly referred to as bonus depreciation, and it allows us to take a percentage of the property basis in the year that we place that property in service. For 2024, that is 60%. For 25, it's 40%. So for 24, bonus depreciation or special depreciation allowance is 60% of the cost of an item. Bonus is going to apply for property that has a GDS recovery period of 20 years or less, which means those farm buildings, the general purpose farm structures, would qualify for a special depreciation allowance or bonus depreciation. One of the kind of nuances of bonus or special depreciation allowance is that it applies by default. So if I don't want to take bonus or special depreciation allowance, I need to make an election not to take it. And that election, like the elections mentioned earlier when it comes to depreciation method, that election is made on a class by class basis. And once made, that election applies to all property within a particular class life. So if I make that for one 7-year property, then I have to apply that election to all 7-year property. it's important to note, especially when investment in equipment gets above that 3 million $50,000 limit for 179 that I mentioned earlier. It's important to note that we take 179 deduction before special depreciation allowance. So once I get to a certain point in investment, I'm not going to be able to take to rapidly depreciate 100% of my purchases. I can still get to a large percentage, but because of the ordering rules, I'm not going to be able to take 100%. Again, this is going to apply when investment is above $3-4 million of in 1 year. Because the because of the way that elections apply to bonus, it can be less flexible than 179 deduction. So often, if investment is low enough or below that $3 million threshold, I'm going to focus first on taking 179. If I can't, then I'm going to consider bonus depreciation. But again, there's or if there's a farm, a general purpose farm building that I want to depreciate rapidly, then I'm going to look more closer at bonus or special depreciation allowance. But again, there's just less flexibility with special depreciation allowance than there is with 179 deduction. So I put together a table to kind of highlight the differences. And one thing I didn't mention earlier that I intended to, when we talk about different depreciation methods, when we talk about bonus or Section 179, we're not changing the total depreciation that will be taken over the life of that piece of property. Instead, we're changing the timing. So with 200% declining balance relative to 150% declining balance, we're front loading the depreciation schedule, or during that depreciable life, we're taking more early on than we would relative to say straight line depreciation. So again, we're not changing the total depreciation amount that we're taking. We're just changing the timing of those. So as an example here, Justin purchased a new tractor for $100,000. And it's important to note that it is a new tractor. So by looking at table 7.1 in Pub 225, we know that new equipment is 5 years. Because it's 5 years, it's going to be depreciated over 6 tax years. We've kind of laid out what the different methods what the result would be for 2024. So assuming everything else works out, assuming that Justin is able to take Section 179 on that tractor, the first option would be to fully depreciate it in year 1. If for whatever reason that doesn't make sense, the next option would be to take bonus depreciation. That would be 60% in 24, plus the normal first year depreciation for the remaining 40%. So that works out to be 68,000. You can see in that scenario what depreciation looks like in the first year versus the remaining years. If we elect not to take bonus depreciation and don't want to do anything with Section 179, under 200% declining balance, we are under 200% declining balance, 20,000 is the amount we would take that first year, and 32,000 the second year, and then it begins to decline. You can kind of look at the table and compare different options. different methods. But the last line there, the last item is using alternative depreciation system. So we've stretched out the life and we're switching to straight line. So you can see a dramatic difference between taking everything with what section 179, 100,000 available there, all the way down to only taking $7,100, 7140 for that first year for ADS. So a very big range in options and depreciation available. I kind of mapped out or graphed out the differences. I'll repeat again that we're not changing the total amount of depreciation taken for whatever method we're using. We're not changing the total, we're just changing the timing. So you can kind of visually see what is front loaded more relative to other methods and the annual depreciation that might take place for each of those options. So a few more slides here, some thoughts to kind of close out. One of the benefits that we have with all of the depreciation rules that we work with in the ag sector, all of these elections are made after the fact. So we're making those at the time of that the tax return is being prepared. So it does give us considerable flexibility. During the year, I may not know what other income might be. I may not know until late in the year what my farm income will be. So the ability to make these decisions after the fact provides a considerable amount of flexibility in tax planning. Again, I mentioned earlier that we're not changing the total depreciation taken. We are just changing the timing. So when I do choose to accelerate depreciation, either using section 179 or bonus depreciation, I'm kind of stealing depreciation from the future to be able to do that. So I'd need to really spend some time evaluating whether or not that trade-off is going to be beneficial to me. Often it is, but there is a trade-off when I make that election. It's also important to point out that several states don't couple with IRS with federal rules when it comes to either section 179 or bonus depreciation. So that can dramatically change the picture of what is important or what I need to look at from a depreciation standpoint. If my state completely ignores bonus depreciation, that changes how I evaluate and the decisions I make when it comes tax time. I have not mentioned depreciation on autos or listed property at all. That by itself could be another hour of discussion. I do want to point out though that that the rules related to autos or listed property can be quite complicated. So don't automatically apply what we've talked about today when it comes to purchasing a pickup or a passenger car to use in your ag business. Very different rules when it comes to that and added complication. So I've highlighted a couple of important references I've mentioned. All three of these prior Pub 225, Pub 946, How to Depreciate Property. Both of those are extremely useful. A lot of good information there. And again, ruraltax.org. A lot of good information there as well on a variety of farm tax related subjects. So I'll close with a picture from my back deck. I often have beautiful sunsets, so it's a just wanted to show that off a little bit, I guess. And I think we have a few minutes maybe for questions. If we don't get to those, then we will we'll make an effort to reach out to you if to you otherwise.
Now, Mark, there's a couple of questions in the Q&A. Some of them are a little bit more general, and then I think some of them are specific to your examples. I can read them to you, or if you can see them, we can work through them.
Let me see if I can.
Yeah.
I guess go ahead and read them to me.
Yep. So there's a couple of questions about depreciation for greenhouses. One was, are commercial greenhouses excluded from depreciation conventions? And then the other question was, if you're building a greenhouse, basically, I guess, when would a basis, it was a question about basis and like date of completion versus like when you incur those costs.
Yeah, that's a good question. So a commercial greenhouse is for the most part is going to be considered a single purpose ag or horticultural structure. So similar rules, it's going to fall into that class, the grouping, the rules that we've talked about already. Placed in service date for those is again when it's ready and available for use. It doesn't mean, especially with a building, doesn't mean that it has to be 100% complete. I'm maybe going out on a limb and saying that, but when it is ready and available for use, maybe there's a few little things that need to be finished up. Maybe some fans to install or lights to install or things like that. But if it, in general, if it's ready and available, then it's going to be placed in service.
All right, and let's see, there's questions about can you depreciate buildings and equipment that you inherit, and is there a time frame within which they must be put in service?
That's a very good question. Something I did not address at all. Very good question. So if you inherit something, if I inherit a piece of equipment, as of date of death of that, the person that passed away, that I'm inheriting from, the value as of their date of death becomes the basis in that property. And I start depreciating typically from that point, assuming that I have an ongoing business, then I'm going to start at that point. If there's not a business then, and I later put it into use, there's some different rules that apply. But in general, the basis of that equipment is fair market value on date of death. And that would apply to both equipment, land, although I'm not going to depreciate the land, but ag buildings, land, ag equipment, livestock, that same general concept would apply.
And there's a question, if not inheritance, but if you purchase a farm with a home on it, how does depreciation work, especially if you're using that for rental income?
So if I'm purchasing a piece of ground that has, let's say, some farm buildings on it that I am going to use as for my ag business, maybe it's got some pens for livestock, maybe a house on it that if the intention is to rent that out, then we're going to kind of parcel that out. We're going to determine, hopefully, or we would work that out with the seller, where we define this much we're going to apply to the house, this much we're going to apply to the pens, this much we're applying to the buildings, and the remainder is going to go to the land. There's kind of a maybe a conflict there From a seller standpoint, they would like to have more applied to the land. From the buyer standpoint, I want more applied to depreciable equipment. So there might be some give and take there. But kind of chunking things up or chunking things out and applying different values is where I would start in that case.
Okie dokie. And then I think there were some specific questions that came in while you were talking about some of your depreciation examples. One was about bonus depreciation. It was a clarifying question. Is bonus depreciation on top of the regular deduction?
So no, I guess it kind of depends on the way you look at that. Bonus depreciation would, if I take bonus depreciation, maybe I'll go back to that, to my example here. I've got $100,000 property. If I elect or if I don't elect out of bonus, then 60% of that is kind of set aside, and I'm taking that 60% up front. The remaining 40%, I'm going to depreciate then over that useful life. So it's not necessarily on top of. It's kind of I would say more in lieu of or separating from normal depreciation.
Right. And I think also there's a couple questions came in about the half year deduction. Can you walk through that again and how that declining balance gets adjusted?
Yes. So with half year, essentially, instead of taking a full year of depreciation in the year that something's placed in service, if the half year convention applies, and this would get a little bit into the weeds, but if you make the calculation or do the calculation for that 200% declining balance, that first year, I'm just taking half of that. What I calculate, I divide by 2, and that is the first year depreciation. The tables that I mentioned in Appendix A of 946, those tables, they're separate tables for half year and mid quarter for each of the 4 mid quarter scenarios. So those percentages, those amounts would already take the half year versus mid quarter into account. So you don't need to make any adjustments to those. Just use the values that are in those tables.
Okay, thanks. And then somebody asked, can you speak to the recapture rules on assets sold before their depreciation period expires, in which section 179 or bonus depreciation was taken?
Right. Right. We did not address recapture at all. And that's probably another hour discussion by itself. In general, though, if I were to dispose of an asset prior to the end of its depreciable life, then I would have basis remaining on that, and that basis remaining would be subtracted from the sale price or the amount I'm going to realize. And in essence, I haven't gotten to deduct that as a depreciation expense, but I'm also not going to pay tax on that amount of basis when I sell an item. So I don't lose out on anything by disposing of something early. I still have basis, and I would still I'd still get to the benefit of that, even though I have not depreciated it.
Thanks. Okay. I think there's one more. Let's see. Somebody asked if you could talk about field tile depreciation.
Um, yeah, field tile, it's kind of a different animal. And I guess maybe if there is a specific question related to field tile, we can address that individually, but it's there can be some nuances related to that need to be addressed. So I may defer on answering or going much deeper on field tile.
Let's see. Somebody asked about power lines, if they're basically an eligible component of depreciation. I guess if you're installing power lines and running power to a building that you're building.
That's I'm gonna say more of a facts and circumstances, but I would consider electrical service to the building as part of the cost of the building. So that would be, at least in my opinion, would be included with the basis of the building, the cost of building it, which would then be fully depreciated together as a group.
And then there's two questions here in the chat that aren't, I think, let's see. Okay, there's a couple more questions that have come in. Oh, here's a good one. So maybe you could speak a little bit about like landowners versus renters taking depreciation when they like are installing a depreciable like asset or something on property that you're renting. But you as the producer are doing that, how that might get treated in different scenarios.
That's a good question. So a good example of that might be I rent land from somebody else, and it has an existing pivot on it, existing irrigation system. Maybe I want to replace that. So I, as the tenant, purchase that, place it in service. I would depreciate that just like I would anything else. Although, I would want to make sure that my rental agreement with that landlord has provisions for a payback of that. If I were to spend $100,000 on a pivot, um, I want assurances that I'm going to be able to farm that ground for an extended period of time. And if I can't, if I'm not going to be able to, I want to make sure that I'm reimbursed or made whole for that item. So not necessarily a depreciation question. I would still depreciate that pivot in that example, just like I would any other pivot that I'm purchasing. I just want, outside of the depreciation realm, I want to make sure that I'm covered if something changes with that rental arrangement. And the same thing I think would apply with a building on land that I don't own. That's maybe a little bit more in depth, or that building has likely has a longer life than a pivot would. So I want to make sure I'm covered if something changes with that rental arrangement.
Gotcha. Let's see. There's a few more questions in the chat. I guess one is related to appraisal and like determining value of these depreciable assets. With regards to your tax filing, not for selling.
Um, I'm assuming that this would be in a context where there's an inheritance, um, that there, and in a lot of cases when there is an inheritance, I do want some sort of appraisal to determine that market value, to determine how much my cost is. That could be a difficulty with machinery and equipment. Land, not as much, but definitely with machinery and equipment, there's not necessarily appraisers out there that are um, uh, capable of appraising equipment. A lot of times we suggest that people use maybe a replacement value or a value that for insurance purposes. Sometimes you can have a local dealer give you an appraisal, although they're not official. Those can work in those scenarios, in those situations. Hopefully I that was the context of the question. If it was something different, then let me know and I can address that.
Yeah. I'm just looking here. I think there's a few questions left. Some of them I've asked for some clarification on. Like there's one that's open here that says depreciate buildings versus non-farm income. Can you depreciate rental home farm building versus non-farm income? I don't know if that's with regards to your farm, like if there's a home that you would depreciate on it that you've leased out, or I'm not quite sure what this question's getting at. You might have a better sense than I do, Mark.
I'm not quite sure either. I mean, a rental property, a rental home, a rental house, residential rental property is depreciable. It's depreciated over 27 and a half years. If that's like we talked about earlier, if that's purchased as part of land that and with farm buildings that I'm going to depreciate on as part of my farm business, I can kind of separate that from a depreciation standpoint. Otherwise, I guess I'm not quite sure what um, the question refers to. I'm glad to, if someone wants to reach out, ask more questions. My contact information is up here. I'm very willing to answer questions if I haven't addressed something.
Okay. Well, I think that is, it looks like that's all the open questions then. So thank you very much. As you can see, folks, Mark's email is in here. And just as a reminder, this was recorded. All the slides, the recording will be posted on farmers.gov/taxes in a couple of weeks. So thank you everyone for joining and have a great afternoon.
Thanks everyone for taking the time.